All right, let's talk about stock dividends. You've definitely heard the term, but what does it really mean for your wallet? Is it actually free money? A sign of a super healthy company? Or is there something more going on? Well, we're going to break it all down.
You know that old saying, it pays dividends, right? It means a smart choice you make now is going to benefit you down the road. Well, in the world of investing, that's not just a metaphor, it's a real thing. Companies will literally pay their investors dividends as a direct financial reward for being a shareholder. So, here's the game plan for today. First, we'll cover the absolute basics. What even are dividends? Then we'll get into the mechanics of how they actually work. After that, we'll dive a little deeper into things like taxes. Then comes the really important part, the hidden catch that a lot of investors miss. And finally, we'll tie it all together so you have a smart strategy you can actually use. Okay, let's jump right in with the most fundamental question of all. What exactly is a dividend? I mean, where does this money even come from?
So put simply, a dividend is just a company sharing its profits with you, the shareholder. Think of it kind of like earning interest in a savings account. You've put your money with them, and in return, they're giving you a little something back as a thank you. See, any company that makes a profit faces this one huge choice. On one hand, they can pour that money right back into the business to grow even bigger and faster. You see this a lot with newer, high-growth companies. Or they can choose to give a slice of those profits to their shareholders, and that's a dividend. This is way more common with older, more stable companies that are past that explosive growth stage. And a steady dividend is often seen as a really good sign of financial health.
Okay, so we've got the what. Now let's get into the how. How does that cash actually travel from the company's bank account all the way into yours? Well, the good news is the math is refreshingly simple. Let's say you own 10 shares of a company, and that company says, hey, we're declaring a quarterly dividend of $1 per share. That means, boom, you get a $10 cash payment for that quarter. If that happens every quarter, you've just made $40 for the year, just for holding onto the stock. Now, let's be real. Dividend yields alone probably aren't going to make you a millionaire overnight. The average annual yield for most companies is somewhere in the 1% to 2% range. But, and this is a big but, about 75% of all the companies in the S&P 500 pay them, so they are a huge part of the investing landscape. And here's a really powerful strategy you should know about. Instead of just taking that cash and spending it, you can often enroll in what's called a Dividend Reinvestment Program, or DRIP for short. This automatically uses your dividend money to buy more shares of the same stock, and sometimes you even get them at a little discount. It's a fantastic way to let your investment compound and grow over time without you having to lift a finger.
All right, you've got the fundamentals down. Now, let's get into some of the nitty-gritty details that really separate the novice investors from the savvy ones, starting with everyone's favorite topic, taxes.
You gotta know that when it comes to taxes, not all dividends are created equal. If you've held onto a stock for more than 60 days, your dividend is usually considered qualified, and you get taxed at the lower long-term capital gains rate. But if you've owned it for less time, it's unqualified and gets taxed at your regular and usually much higher income tax rate. The bottom line here is simple. How long you hold the stock can make a huge difference come tax time.
And hey, dividends aren't just for people who own individual stocks. You can also get them from index funds and ETFs, which is great because you get a piece of the dividends from all the different companies inside that fund. Bonds pay out a form of dividend too. We just call it interest. And you can even find them in some mutual life insurance policies. They're all over the place.
A steady stream of cash just for owning a stock? I mean, it sounds amazing, right? But there's a catch, and it's a really important one that a lot of new investors just don't see.
This brings us to the single most important question you can ask about dividends. Is this truly free money? Is a dividend a real bonus that's being created out of thin air and dropped into your lap?
The answer, and you need to hear this, is a clear and simple no. Here's why. When a company pays out cash as a dividend, that money is leaving the company. So the total value of the company actually goes down, and its stock price will almost always drop by an amount very close to the dividend it just paid. Think of it this way. The money isn't being created, it's just being moved from one of your pockets, the value of your stock, to another one of your pockets, your cash account.
And sometimes, a high dividend is actually a huge red flag pointing to a serious problem. The classic cautionary tale here is General Motors. For a while, the company was really underperforming, but it wanted to keep its shareholders happy, so it made a terrible decision. It started taking on debt, borrowing money, just so it could keep making its dividend payments.
This quote just nails it perfectly. What was happening was, this is basically the shareholders taking out a loan to pay themselves.
It created this illusion of getting an income, but the company itself was getting weaker and weaker. The investors who weren't paying close attention got burned and ultimately lost money.
So, here's the big lesson. You have to be really, really cautious of an exceptionally high dividend yield. I know it looks tempting, but it can often be a warning sign that a company is in deep financial trouble and is just trying to lure in investors before things go south.
Okay, we've covered the good, the bad, and the really important fine print. So now let's put all of this information together into a clear, actionable strategy that you can actually use.
You know, when it comes down to it, your investment strategy really boils down to this one fundamental trade-off. You can go for classic dividend stocks like a Coca-Cola or a Target and get that stable, consistent income, but with slower growth. Or you can aim for those newer growth companies that reinvest all their profits for potentially faster growth, but pay out little to no dividend. Neither one is better, they just serve totally different financial goals.
So, to help you make smart decisions, here's a little checklist to keep in your back pocket. 1. Never ever invest in a company just for its high dividend. 2. Always look under the hood at the company's overall financial health. 3. Understand that dividends are always a trade-off with growth. 4. Remember, getting that dividend check is really just like selling a tiny piece of your stock. And finally, number 5, always aim for a balanced portfolio that actually fits your personal financial goals.
So, we'll leave you with this one last question to think about for your own investments. When you get that dividend payment, do you see it as a reward, or do you now see it for what it truly is, simply a withdrawal from your own portfolio? How you answer that one question will pretty much shape your entire investing strategy. Thanks for tuning in.